Well, I agree that the U.S. is benefiting the next 3 years, maybe even 10, 20 years from its leadership in AI. But I kind of agree with Professor Siegel that, if I look at the next 3 months, so not 3 years, I do think three tests are emerging for the stock market. One is, of course, how is the Fed going to react to both the underlying inflation risks? The second is the market doesn't really like when inflation is a concern and yields are rising. And I do think we are seeing it now in PPI. I think there is in the pipeline a lot of inflation, not structural, but just inflation shock, but also energy shortage. And the third, of course, is, I think we have a lot of IPO and that's a lot of supply. So I think we're going to face some tests later this summer. So I think the risk reward is still great for tech, but I'm not sure about the broader market.
How would you respond to that? I mean, the market, some have suggested, has been whistling past the graveyard.
Tom Lee is essentially saying that while the United States may continue benefiting from its leadership in AI over the long term, the next few months could be much more challenging for the stock market. He agrees that the future of technology, especially AI, remains strong for the next several years, but he is more concerned about short-term risks that investors may be underestimating. According to Tom Lee, three major tests are starting to emerge for the market. The first is how the Federal Reserve reacts to inflation risks. If inflation remains stubborn or starts rising again, the Fed may keep interest rates high, which usually creates pressure on stocks. The second concern is rising yields combined with inflation fears, because markets generally dislike periods when borrowing becomes more expensive and economic uncertainty increases. He believes inflation pressure is already building, not as a permanent structural issue, but as a temporary shock fueled partly by energy shortages. The third issue is the growing number of IPOs entering the market. When many companies go public at once, it increases supply and spreads investor money across more opportunities, which can weaken the broader market. Overall, Tom Lee believes tech still has strong upside potential, but the broader stock market may face serious challenges later this summer.
A conundrum for you, perhaps, and maybe other investors. When you said, yes, I still am bullish on the AI trade, but I don't really like other parts of the market in the environment that we could be in with inflation in the pipeline, as you said, and shocks in inflation, nothing structural, but nonetheless concerning, the rise in oil, the backup in yields. But then if I sit back and I say, well, how can I lean in now to parabolic moves that have already taken place? And at the same time, I don't like any of these other areas of the market because I agree with Tom, then what in the world do I do?
All right. So, Scott, I'm going to say something that might make the audience think I'm puzzling, but the move in DRAM, in my opinion, is actually somewhat defensive because we know that if you're worried about inflation and petroleum shortage, there's even bigger shortages in memory. So like people are buying what's going to work even if the macro environment gets tough. And I think that's why it makes sense for semis and DRAM to still do really well. And so I think that this pullback is going to be viable there. But to me, if someone's trying to make a bigger bet on tech, I think the really attractive risk reward is still Mag 7 and software. And Bill Ackman's buy of Microsoft really reinforces it. That's why software is actually still among our top picks right now.
What Tom Lee is also trying to highlight here is the difference between long-term optimism and short-term market reality. In his view, investors should not confuse America's strong position in artificial intelligence with the immediate direction of the stock market. Just because AI innovation is accelerating does not mean stocks will move up smoothly in the near term. Markets often react to economic pressure before they react to long-term growth stories. That is why Tom Lee appears cautious about the next 3 months, even though he remains optimistic about technology over the next decade. He is also pointing toward investor psychology. When inflation fears return and bond yields rise, many investors become nervous because higher yields make safer investments more attractive compared to stocks. This can lead to volatility, especially in sectors outside of technology. At the same time, if energy shortages push costs higher, companies may face pressure on profits, which can further affect stock performance. Another important point Tom Lee is making is that markets usually struggle when too many uncertainties arrive at once. Inflation, Federal Reserve decisions, rising yields, and heavy IPO activity together could create short-term turbulence. However, he still sees technology as one of the strongest areas for long-term investors despite broader market uncertainty.
This has just gotten a little bit out of hand. You agree?
Well, first of all, I wasn't disappointed with the summit because I didn't expect much of anything. I didn't really believe that there was going to be some sort of amazing deal coming out of it. And we are in an earnings-led melt-up. The fundamentals are definitely there for for what's been happening, and so valuation multiples haven't really gotten all that stretched relative to earnings. And I mean, that's one of the reasons we came back so strongly since the bottom on March 30th, as investors suddenly realized that the PE had come down to a large extent because E had gone up to a record high and stocks looked really cheap. So, I think we have to kind of take out the bumps in the market, and I think the trend is still very much intact.
But you heard what the professor said about the idea that investors are making this bet that this earnings ramp is going to go from here to infinity. I mean, you've been thinking about this. Didn't you call this like the Buzz Lightyear market or something like that the other day?
I have this Buzz Lightyear theory of to infinity and beyond.
Are we making a mistake thinking what has traditionally, as he said, been a cyclical part of the economy is somehow secular now, and we're just going to project this out from here to 20 years from now?
I think the AI may be a bigger deal than people understand, and I think the stock market's kind of hinting at it. I think, economists usually view the economy as having three main resources: land, capital, and labor. I think data has become a fourth factor of production. And we've all been collecting data, it's been stored away, and we really haven't squeezed it for all it's worth. And that's what AI is doing. It's the digital revolution. It started in the 1960s, and we've accomplished an amazing ability to process a huge amount of data really quickly, really cheaply. And as we continue to do that, guess what? We create more data. There'll be never a shortage of data.
Tom, how do you assess this?
Here, Tom Lee is explaining why he still remains optimistic about technology stocks, even though he has concerns about inflation and the broader market. He believes the economy may actually surprise people by staying stronger than expected, and that economic strength could continue supporting stock prices. However, he also recognizes the dilemma many investors are facing right now. On one side, AI and tech stocks have already made huge moves higher, making investors wonder if they are too expensive to buy. On the other side, many traditional sectors of the market look risky because inflation, rising oil prices, and higher bond yields could create pressure. Tom Lee's argument is that certain parts of technology are not just growth investments anymore. They are becoming defensive investments as well. He specifically points to DRAM memory and semiconductor companies, saying that if people are worried about shortages in oil or inflation shocks, there are actually even stronger shortages happening in computer memory, especially because AI systems require enormous amounts of chips and memory to function. In his view, investors are buying areas that can continue growing even if the broader economy becomes difficult. That is why he believes semiconductor companies and DRAM-related stocks could still perform well after market pullbacks. He also says the biggest long-term opportunity remains in the Magnificent Seven technology companies and software stocks. According to Tom Lee, even major investors increasing exposure to companies like Microsoft strengthens the case that software and big tech are still among the strongest investment opportunities despite broader market uncertainty. Concerns that the stock market may be overheating or becoming too optimistic. His main argument is that the recent market rally has not simply been driven by hype. It has been supported by
this tremendous move that we've seen in oil, and now you have yields joining it, and you've had some of the inflation data this week get a little alarming. Have we been doing just that, ignoring what's right in front of our face, and there's going to be a comeuppance as a result?
Tom's view is very plausible, that we may have a stretch here of a few weeks, maybe a few months, where the market consolidates. We just had a pretty significant pullback in the market from the beginning of the year, basically, really from October of 2025, when the big cap stocks had a really quite a significant sell-off. And so we've already had the pullback. I guess people would like to have another opportunities to buy here. But yeah, I mean, there's still this issue of the bond yield, but I think the bond yield is reflecting a normalization of the economy.
I know, but the parabolic nature of this move SMH up 6 straight weeks.
Yeah.
We could end that this week, but nonetheless,
Yeah.
up 6 straight. The DRAM ETF began this week with $6.25 billion in assets under management.
Sure.
Finished yesterday with $9.5
Yep.
billion. It only had $77 billion a month ago. Nvidia up 7 straight days. The Qs have been up so much they need to fall 12.5% just to get back to the 50-day.
And all of that was triggered by the first quarter earnings season, which was phenomenal. As Professor Siegel said, I don't think any of us recall a situation where earnings have been surging in such a way other than coming out of a recession. So the fundamentals are good. Look, I think the bond market's reacting to better than expected economic growth. It does look as though the economy is going to be showing something like 3 to 4% growth in the second quarter. It was weaker than that in the fourth and the first quarter, and some of that had to do with the government shutdown, then some really cold weather. So I think we're going to be very pleasantly surprised by the strength of the economy, and that's what will keep the market going.
I feel like, Tom, you painted a bit of
Strong corporate earnings. He explains that many investors expected some major breakthrough from the summit being discussed, but he personally never expected dramatic outcomes, so he was not disappointed. Instead, he believes the market rise has been fueled mainly by fundamentals, especially stronger than expected company profits. Tom Lee is saying that stock valuations are not as excessive as some critics believe because earnings have increased significantly. In simple terms, even though stock prices have risen sharply, company profits have also gone up, which helps justify those higher prices. He points out that after the market bottom in March, investors realized stocks were actually cheaper than expected because earnings had reached record highs, making the overall market look more attractive. At the same time, he addresses a major fear from skeptics. Are investors assuming growth will continue forever? Some worry this optimism resembles unrealistic expectations, especially in industries that were historically cyclical. But Tom Lee believes AI may be far more transformative than people currently realize. He argues that traditional economics focuses on land, labor, and capital as the key drivers of growth, but now data has become a fourth factor of production. According to him, businesses have spent decades collecting massive amounts of data without fully using it. AI is finally unlocking that value by helping companies process enormous amounts of information faster and more cheaply than ever before. Tom Lee sees this as part of a much larger digital revolution, one that began decades ago but is now accelerating rapidly. As AI improves, more data gets created, analyzed, and turned into productivity, which could potentially reshape industries and fuel economic growth for years, rather than just a short-term market cycle. In this discussion, the expert is responding to concerns that investors may be ignoring serious warning signs like rising oil prices, higher bond yields, and inflation risks while continuing to push stocks higher. The fear being raised is whether the market is becoming too optimistic and whistling past the graveyard, meaning investors are acting like everything is fine, even though potential dangers are clearly visible. The expert acknowledges that Tom Lee could be right about the possibility of a short-term pause or consolidation in the market over the next few weeks or months. However, he argues that markets have already experienced a meaningful correction earlier, especially in large technology companies, which gave investors a chance to reset expectations. In his view, this means some of the excess fear and overvaluation concerns were already addressed during previous pullbacks. He also explains that while rising bond yields remain a concern, they may not necessarily be a bad sign. Instead of signaling economic trouble, higher yields could actually reflect a stronger and more normal economy. The expert believes the market rally has been heavily supported by exceptional first-quarter earnings, something rarely seen outside of recoveries after recessions. Companies are making more money than expected, and that profit growth is helping justify higher stock prices. He points to explosive moves in technology and semiconductor-related investments, especially AI-linked companies, as evidence of strong investor confidence. While some people worry these gains look excessive or parabolic, he argues the momentum has been driven by real business performance rather than pure speculation. Strong earnings, expanding economic growth, and improving business conditions are giving investors confidence that the rally still has room to continue. Most importantly, he believes the economy may be much stronger than many expect. He predicts growth in the coming quarter could surprise to the upside, possibly reaching 3% to 4%, after weaker periods affected by temporary issues like government disruptions and poor weather. According to this view, stronger economic performance may continue supporting both corporate profits and the stock market despite fears surrounding inflation and rising yields.